Hello and welcome to Close of Business. I'm David Chau. Coming up on the program, all eyes on the Reserve Bank with predictions it's poised to slash rates from a 13-year high.
I hope that perhaps the rate might come down again because any little rate cut would actually make a tremendous difference in our household.
And with coal and gas prices surging, a former regulator questions why power bills are so high.
That can legitimately be called price gouging. Consumers are clearly being exploited, driven by an underlying lack of competition.
Also on the program, Australia's growing e-waste problem and how a change from Microsoft could make it worse. But first, with the cash rate at its highest level in 13 years, it's no wonder most borrowers are desperate for rate relief. And if the markets are correct, the wait could soon be over. But how much relief will that actually bring? And how quickly? Here's Emily Stewart.
How are you?
Raj Menon checks in with his mortgage broker every 6 months to make sure he's getting the best home loan rate.
We all believe the RBA is going to cut.
He bought his dream house in 2020 and has seen his interest rate go up by about 4 percentage points since then.
Every month I see or hope that perhaps the rate might come down again because any little rate cut would actually make a tremendous difference in our household.
The official cash rate has sat at its current level of 4.35% for more than a year, but soon there could be some relief for homeowners like Raj.
Since the start of the year, we've seen a huge uptake of clients, whether or not they're new or existing, come to us to try and understand what their borrowing capacity looks like. With the onset of a rate cut, hopefully next week, and maybe more to come.
Economists had been predicting a cut in May, but have shifted their forecasts forward, with all 4 big banks expecting a 0.25 percentage point cut in February. It's all because of recent data showing underlying inflation has moderated more quickly than the RBA expected.
I think what they're going to say is they've redone their forecasts. They're now finding that you'll be in the middle of the target range, either by the end of this year or early next year.
The number of rate cuts is hotly debated. In the next year, ANZ is predicting 2, while CBA and Westpac think there'll be 4 and NAB is forecasting 5.
I think they'll basically just maybe do 25 per quarter, and we have rate cuts down to 3% by early 26.
If there is a rate cut in the next meeting, homeowners with a $750,000 mortgage and 25 years left on the loan should see their repayments fall by $115 a month. That's based on an average variable rate of 6.33%. Even if the banks pass on the rate cut, it's a good idea to contact your lender, since some won't automatically adjust your minimum monthly repayments unless you request it. Lenders are already cutting fixed rates to lock customers in.
Fixed rates have come down off the boil, but they have probably got a lot further to fall. We expect to see a flurry of fixed rate cuts come through should we see a cash rate cut.
During the height of the mortgage wars in 2022, non-bank lenders were accessing cheap funding on the wholesale market and could offer the cheapest rates.
These days, the higher rate market has turned this on the head. Banks are now relying increasingly on deposits to fund their home loans. The non-bank lenders don't have access to deposits because they're not banks. As a result, the lowest rate lenders on our database right now are from smaller banks and credit unions.
There was already media talking about what rates were doing.
Raj Menon is currently with one of the bigger banks.
A remortgage is always on the cards, particularly if there's an interest rate cut.
Which he's hoping could save him hundreds of dollars a month.
For a closer look at what to expect from the Reserve Bank next week and the Trump administration, I spoke to AMP's chief economist, Shane Oliver. Hello there, Shane. Borrowers with big mortgages are really looking forward to next Tuesday. Money markets and the big 4 banks are betting the Reserve Bank will almost certainly cut. But do you think it's a done deal, or is there a risk the RBA will disappoint them?
Look, I don't think it's a done deal, but I do think the RBA will cut. Money markets are saying something like a 90% probability. I reckon that's a bit too high. I'd say it's about 75% chance that they will cut. But the good news is we have seen a fall in inflation. not just the headline rate, but the underlying rate of inflation has come down as well. That is what the Reserve Bank has been telling us that they want to see. They have told us that if we start to see that and they have more confidence about falling inflation, then they'll be in a position to cut interest rates. Against that, though, you can make an argument, well, the Aussie dollar is fairly weak, the jobs market is still fairly tight, there's uncertainty about Donald Trump's tariffs. But I think all of those arguments are relatively weak. They're not strong enough to head off a cut on Tuesday, but by the same token, there is still that chance the Reserve Bank might decide to wait a little bit longer.
So how much rate relief can we expect to see by the end of the year? And is it possible the federal election might complicate things?
Look, I think we'll see 3 rate cuts this year, one on Tuesday, another one in May and then another one in August. That'll take the official cash rate down from 4.35% currently to 3.6% and probably knock a similar amount off, in other words 0.75% off an average mortgage. Bear in mind, though, that the Reserve Bank hiked 13 times, so this is only reversing some of the pain that was inflicted on mortgage holders, so we're still going to have relatively high interest rates. In terms of the election, yes, it is a factor. The Reserve Bank won't openly say that it's affected by the election. It probably doesn't want to move rates again in the election campaign like it did back in 2022 and 2007. That can then make the Reserve Bank a bit of an issue. But I do think that if they want to get a rate cut done, they'd probably want to get it out of the way now before an election campaign is called. If they leave it till April, say, they could find themselves in the midst of an election campaign or in a situation where one is about to be called.
And Shane, over in the US, some economists say inflation could be reignited by President Trump's policies. But here in Australia, inflation is within the RBA's target range. Is there a chance it could rise again?
Look, there's always a risk that inflation might have a rebound in Australia. To be honest with you, I don't think Trump's policies will cause inflation in Australia. Yes, they do risk adding to inflation in the US. If he keeps jacking up tariffs, that means imports. The price of imports going into the US keeps getting higher and higher. So that can add to US inflation. That is a reason for the US Central Bank, the Fed, to be cautious. But there's no reason why his tariffs should add to inflation in Australia, unless, of course, we have tariffs put on us and then we retaliate with tariffs on US imports. I don't think that's going to happen. Or alternatively, the Aussie dollar collapses. Again, I don't think that's going to happen. The biggest risk for Australia from Trump's policies is actually a hit to economic growth. He keeps ramping the tariffs up. That slows down global economic growth, less demand for our exports, slower growth and demand in Australia. That is the biggest risk, and I think the Reserve Bank would be aware of that. And therefore, if anything, you can make an argument that the tariffs are more an argument to cut rates rather than to leave rates on hold.
So there's a real risk, as you identified, we could see a protracted global trade war. If that were to happen, what's the worst case scenario for us? And on the other hand, could there be an upside? Look, there is certainly a risk here of a global trade war. Donald Trump seems to be releasing his tariff announcements with much hype, every few days. And of course, some of them he's delaying. So maybe that's good news. There'll be negotiations, but it looks like there are more tariff announcements to come. That does run the risk of a global trade war where other countries retaliate, leading to a slowdown in global trade, adversely affecting global economic growth. So that's certainly a risk. The worst case scenario here is where this spirals out of control. We saw an example of that in the 1930s, a very extreme example, so hopefully it's nothing like that. But that leads to lower economic growth and obviously an adverse impact on the Australian economy. To be honest with you, I think there are some brakes on Donald Trump, though. He does want the US share market to rise. So far it's done that, which may embolden him to do more, in fact. But ultimately, if we do see big falls in share markets on the back of worries about tariffs impacting global growth, then Donald Trump will start to get nervous. There's also another issue here that Americans will face an increase in their cost of living. American consumers are already starting to see that, as evident in various surveys of American households. They're getting worried about rising inflation in the US. They voted for Donald Trump to reduce the cost of living, not add to it. So if he starts adding to the cost of living, when people go to Walmart, they've got to pay more, a lot of Americans won't be very happy. They'll put pressure on their Republican representatives in Congress, which in turn will put pressure on Trump. So ultimately there are some constraints around Donald Trump, even though he doesn't face the political constraint of having to get re-elected again because this is his last term. Shane, thanks so much for breaking it down so simply for us.
Thanks, David. Take care.
The nation's largest home lender has beat expectations after posting a $5.1 billion half-year profit. Now that's a 6% increase from the same period a year ago. CBA's net interest margin rose by 9 basis points to 2.08%. And the bank has lifted its interim dividend to $2.25 a share. Our business editor, Michael Yander, asked the bank's CEO, Matt Comyn, whether borrowers can expect to see any rate cut passed on in full.
Almost $1 billion a month in profit. If the Reserve Bank cuts interest rates next week, surely you can afford to pass on that rate cut in full to your customers.
Yeah, as you'd expect, we've given that close consideration. We understand how much our customers and the broader community are looking forward to rate relief. But hopefully, as you'll also understand, I can't announce what we might do next week, but other than to say we're, of course, acutely aware of how much our customers would be looking forward to rate relief.
And what factors would you be considering when you consider how much of any future Reserve Bank rate cuts to pass on?
There's always a lot of factors in terms of that are taken into account in terms of funding, changes in the market, etc. This is, of course, a rate cut that has been contemplated for some time. Of course, we've given consideration to what might occur. I think the market's pricing in about a 95% chance of a rate cut. I don't think it's that certain, but we do believe that the return to inflation and underlying inflation, importantly going into the target band, hopefully gives the RBA scope to be able to reduce the cash rate.
Two of Australia's biggest energy companies, Origin and AGL, have posted strong profits this week. And they're planning to up their investment in the transition to renewables. But the former head of the ACCC says the public should be asking why more isn't being done to ensure consumers pay less for electricity and gas. Rihanna Whitson reports.
Yeah, so what are we packaging now?
This is a tropical, bud.
I heard we had...
Energy-intensive businesses like this have been hit hard by increased power bills.
Electricity for all of our process requirements, pumping, chilling, packaging. We're also significant consumers of gas. So these robots that automatically stack our slabs, they are efficient, actually really efficient use of power.
Carl Van Buren is doing everything he can to reduce costs at his brewery.
In the last 6 months, we've been able to reduce the amount of gas that we consume by 19%, and we've also reduced our electricity by 8%. In addition to that, we've got 100 kilowatts of solar panels on the roof, which provide somewhere between 20 to 30% of our power requirements.
Some manufacturers have not survived, blaming soaring energy costs for shutting down Australian operations. High coal and gas prices have also increased costs for electricity generators and retailers. But some companies that also produce gas, like Origin, are doing okay. Origin Energy's half-year profit increased 2% to $1 billion, driven by earnings from its East Coast LNG business, which benefited from higher gas prices and offset lower earnings from selling and generating electricity. Power generator and retailer AGL was also squeezed by lower wholesale prices and increased costs. Its profit fell 83% to $97 million, despite signing up more customers and increasing sales by 15%.
They all have very large growth programs of reinvesting money in the assets that we need up and down the East Coast to keep the lights on. So without the profitability today, they would not be able to afford the assets that we need for tomorrow.
Between them, AGL and Origin have about 9 million customers. Their profits come after the federal government's $3.5 billion in energy price relief rebates for households and small businesses. Some say instead more should be done to prevent electricity and gas customers being charged so much in the first place.
The public is entitled to be concerned if there's a big energy subsidy to an energy company and its profits go up significantly. Energy prices could and should be lower.
While investigating the broader market, former ACCC Chair Alan Fels found evidence of loyal customers being charged more.
That can legitimately be called price gouging. Consumers are clearly being exploited, driven by an underlying lack of competition.
AGL and Origin say their retail margins have decreased and they don't price gouge customers.
I think it's very hard to form a view that there's price gouging in the market at this point in time. We have a very actively engaged regulator who's very focused on the default market offer and retailers who are actively providing that offer to customers.
This AGL customer still thinks his electricity bill is too high.
We spend about $1,500 a quarter on electricity, nearly $5,000 a year. Who's that?
While the father of two works in the energy efficiency industry, as a renter he's limited by what he can do at home.
The government, although they're trying to do something which is great, could be doing it in a much smarter and much more effective way to create efficiencies in a home more permanently than just handing something out that helps for a very short period of time.
Instead of energy rebates, he wants long-term solutions.
There are growing concerns about the rising popularity of crypto loans. A handful of companies are offering them in exchange for digital currency like Bitcoin or Ethereum as collateral. But economists are warning the sector could threaten Australia's financial stability. David Chau reports.
Johnny Fan is used to managing risks. He runs a firm offering loans in exchange for cryptocurrencies.
We lend against Bitcoin, so if you're looking to borrow $140,000 worth of Australian dollars, then you would need at least $280,000 worth of Bitcoin as collateral. So we use that as a collateral to then allow you to borrow against. No difference to a typical bank lets you borrow against your property.
The business makes money by borrowing cash at an interest rate of 11% and lends out at 15%. If the price of Bitcoin goes up during the term of the loan, the customer can borrow more money. But if it falls sharply, the borrower is asked to stump up more crypto or cash.
So we understand that Bitcoin is volatile, but we don't lend against any other riskier assets.
So Celsius was a crypto exchange.
Borrowing against Bitcoin didn't go too well for crypto enthusiast Bayani Mills. In July 2022, he stumped up 1.6 Bitcoin as collateral for a $20,000 loan from US-based exchange and lender Celsius. Then the value of his Bitcoin dropped.
They're asking us to stump up additional collateral, whether that be USDC, a crypto stablecoin, or more Bitcoin. But yes, they were looking to add more collateral.
Celsius went bust. Bayani lost his Bitcoin and was left thousands of dollars out of pocket.
Essentially, it was a bank run. Everyone's trying to take out their collateral all at the same time, but they didn't have the collateral to be able to release it back to consumers.
The corporate regulator, ASIC, warns the crypto securing these loans could become insufficient to cover them if its value drops quickly. There are only a handful of lenders in Australia accepting cryptocurrencies as collateral for loans. Regulators and the government are monitoring them. But here's the problem. The industry itself wants to grow, but economists warn the further it grows, the more the industry represents a financial stability risk to Australia.
In the event that there's a dramatic reversal in the value of those assets and the market for them dries up, then what history tells you what happens is that people sell what they can rather than necessarily what they should in order to get out of a sticky or illiquid position. And that's how contagion happens from what might be a small asset class of no great systemic significance on its own to assets that do matter from the perspective of financial stability as a whole.
AMP's Deputy Chief Economist, Diana Musina, says that's when governments would need to step in.
If lending in that particular space is seen as risky, which I think it is seen as risky because of the fundamental collateral that is undertaken in that, i.e. Bitcoin, that's sort of the problem for the government because they could potentially have to bail out households or businesses.
Willing to ride the crypto roller coaster.
To the share market now, and there was a lot of enthusiasm about potential rate cuts and company profit results, which drove the ASX and All Ords to new record highs. For the week, they went up by around 0.5% each. And I spoke with NAB Trade's Head of Investor Behaviour, Gemma Dale, for a deep dive into the markets. Hi there, Gemma. The Reserve Bank decision next week is headline news. Do you think it'll have much of an impact on markets?
So it's such an interesting question because there's so much commitment in the market to a cut, right? The market is 100% confident that there will be a cut on Tuesday. And if that doesn't happen, that will definitely move the market. If it does, it's already priced in, right? So I don't know if we're expecting a massive response unless it does something that is not anticipated at this point in time.
And the share market has climbed to its highest level ever, despite all this risk and uncertainty coming out of the White House. Do you think markets are being a bit overly optimistic?
Yes, this one's a fascinating question. You and I were speaking less than 2 weeks ago after Trump had somewhat shocked the market with 25% tariffs on Canada and Mexico, 10% on China, and within 24 hours had walked back a good amount of that announcement after it had already rocked the market. I think what we learned from that experience, because it was a dramatic market response, was markets are pretty complacent about these announcements, and to a certain extent, they're assuming that this is a negotiating tactic. And to that extent, the market is just relying on earnings season and the performance of the underlying company and not worrying too much about the macro environment and the big announcements, because to be frank, we're not 100% certain they're going to happen.
And it's been a busy week this week with all these company results coming out. Did we learn anything interesting?
So it's always interesting. We had CBA this week, and it is fascinating to watch that company continue to rocket. The share price is extraordinary, absolutely extraordinary. Only 18 months ago, you could have bought it for less than $100. Now it's well above 160 and keeps making new ground. The performance is very strong. It's a great company, but analysts continue to be absolutely shocked by the share price performance, which seems to have decoupled dramatically from the company performance. When you look at the other strong and interesting performance this week, I think the healthcare sector has been really weak relative to the rest of the market, and that was primarily CSL and Cochlear. CSL, just not a very strong performance from a company that has continued to impress the market over decades, and then over the last 5 years just underwhelmed. A big Vifor acquisition just not paying off as well as the market would hope. But Cochlear was a shock. It was off 13% today. Very disappointing result relative to what the market's been pricing in. The share price is off 30% from its peak, but it also nearly doubled over the space of 18 months. So it's just been really interesting watching how that one's played out.
And Gemma, Australia's biggest companies will continue to announce their results next week. So just very briefly, what can we expect to see?
So what we've got the big three miners. We've got Fortescue, we've got BHP, we've got Rio. They're always interesting, but we do get regular production updates, so you don't tend to see massive price movements off the back of their results. And then you've also got three of the big four banks giving it quarterly. So it's not a half yearly for these guys, it is a quarterly, but it will give us an idea of how far out in front CBA might be, or if the whole sector is just performing pretty well.
Gemma, thanks a lot for your insights.
Thanks for having me.
As tech companies and manufacturers race to release new technology, unwanted electronic devices are quickly becoming a major waste problem, and it's set to get worse. Microsoft is planning to retire its Windows 10 operating system later this year, a decision that could send millions more computers to the scrap heap. Here's Rihanna Whitson again.
As technology accelerates, so too does Australia's electronic waste problem.
With generative AI, there's a lot of waste and new waste streams coming out of data centres at the moment.
Every year, this company processes millions of discarded computers and other e-waste from large companies, government departments and agencies.
If we absolutely can't refurbish the asset and resell it into our global networks that we have around the world, then we'll recycle the asset. And the rare earth metals and the materials from that particular technology asset will then go back into the circular economy and be used in things like solar panels and other tech.
Australia generates about 500,000 tonnes of e-waste annually. That means each Australian produces about 20 kilograms of e-waste a year, compared with the global average of 7 kilograms. About half is recycled. E-waste is projected to rise nearly 30% by 2030. That worries inner city Melbourne Mayor Pradeep Tiwari. E-waste is banned from landfill in Victoria, New South Wales and South Australia.
There's signs on there, but it's all for all the smaller electrical items, such as hairdryers, speakers, CDs, everything, but not batteries.
But instead of e-waste being correctly disposed of at battery and general e-waste drop-off points like this, it often ends up in curbside rubbish collections, resulting in fires and costly clean-up bills.
As recent as last week, we've had a third incident. The waste truck caught fire. When the contractor, the driver, dumped it out, we found out that it was an old laptop with a battery intact.
Microsoft's decision to end support for its Windows 10 operating system will come into effect later this year and is set to worsen the e-waste problem. It could affect an estimated 240 million PCs across the globe.
In Australia alone, there are more than 6 million assets that will be needing to transfer from Windows 10 to Windows 11 before the deadline of the 15th of October. That could equate to 12 million kilograms of PCs and assets going into landfill.
What we're seeing later this year with Microsoft is a little unprecedented.
Experts say it will leave older models that are incompatible with Windows 11 effectively obsolete.
There will be a lot of devices that are not able to run that new version because we've never had a situation like this with such a common and widespread used piece of software such as Microsoft Windows.
Australia does have a mandatory industry-funded scheme for recycling e-waste, but it only covers TVs and computers. The peak body for the recycling industry, ACOR, says the scheme is far from perfect and lacks transparency. It wants urgent action to ensure the producers of all types of electronic products are held responsible for the waste they create. There are also calls for Australia to broaden its right to repair laws, which currently only apply to cars, vans and utes.
In 2024 we collected 17.5 tonnes of IT and electrical items, and 50% of all the things we collect have a reuse outcome.
It's a statistic that frustrates Darren Andrews. His social enterprise collects e-waste disposed of by households at council drop-off points.
Some brands have actually made it very difficult to repair and replace parts. One of the key things around IT and technology is it's constantly turned over and updated, and so there is almost a built-in obsolescence.
A waste problem that could be solved.
And that's all from Close of Business. I'm David Chau. Thanks for tuning in.